All right, all right, all right. Good morning, everybody. We got a good one today for you guys. We got a good one. We're going to talk about new devs. Got two good colleagues. Steven, how long have I known you, Steven, at this point?
Oh man, I don't know. I think you had hair when I knew you first.
That's got to be about 15
It's
years.
15, 20 years.
15,
Yeah,
20 years.
yeah.
I met you early on. I started in 2005, and I think I met you early on in 2006. I saw you at a presentation,
Yeah, so
and
it's 24 years
I immediately
or 14
resonated
years.
with you. Yeah, that's okay. Yeah, there's no math today. Well, wait a second. There's a lot of
Usually I'm
math
good at
today.
math.
Oh, yeah,
Uh, yeah, no, I
but
mean,
a long time.
yeah, we've known each other a long time. I've loved to watch your career grow and watch your viewership grow, and you always have a tremendous
Oh.
amount of knowledge to share. So I appreciate that.
Thank you. And I just want to say, I don't know if you remember this, but I do. The very first meeting that I had with you, you just welcomed me in right off the bat. You gave me all the information I needed. I was looking for specific data. You sat down with me for over an hour in your office, and you didn't even know who I was. And you're like, come on in. Happy to do it. Happy to talk it out. And I
That's what
never
we
forgot
do.
that. I never
That's
forgot
what
that.
we
So,
do.
yeah,
It's
good stuff.
listen, as far as I'm concerned, you know, when an agent or a broker comes into my office and wants to learn, I'm all ears, and
Yeah.
I learn things from you guys all the time too. So it's a give and take.
I love it. Well, I think you're great. And let's get this going. Let's get this going. I'm going to formally announce you guys. Hello, everybody. I am Noah Rosenblatt of UrbanDigs, and I am proud to have Stephen Kliegerman, President, Brown Harris Stevens Development Marketing. Been in the business since 2000, has held a number of positions at the senior executive level over at Terra Holdings, overseen more than $15 billion in sales. Excellent taste in live music. I've seen it with my own eyes. Okay. Happy to have him here. Thank you, Stephen.
Great to be here. Actually, going to the Cap this weekend to see Dan Donato. So
Oh, there you go. Always goes to the shows. I love it. You're just a kid at heart. I love it. And we got Jason Thomas. Jason Thomas, I've known you for a long time as well. I'm so glad to have you. What an amazing analytical mind. Senior Vice President of Research and Market Analytics for Brown Harris Stevens Development Marketing. Former chemist. Former chemist. I
That's
got
right.
questions. Yeah, but it makes sense. Former owner of a wealth and risk management agency, and you really do take the approach that you need from wealth and risk management and apply it to new development. You like to describe your work as marketing and communication arbitrage. I love it. So here's the
Right.
way we're going to do this, guys. Here's the way we're going to do this. I got a bunch of questions. It's going to be about 20, 30 minutes for Stephen and Jason. We're going to go over a bunch of things. Typically, I ask you guys when you register for these webinars to put a question saying, what do you want to ask these two, right? So I have a list. I forgot to do that. I forgot to do that. Silly me. So if you have questions, put it down there. That's like homework for you guys. There's around 50 plus people here. Hopefully there's more by the end of the show. Put your questions down, what you want to ask about new development. I will circle back to that in the second part of the show and answer those questions with these guys. Okay? So let's begin. Jason, I'm going to start with you. This is more of a philosophical start. We discussed this. We're going to go into the state of the market second. First, you guys changed a bunch of stuff. You changed a bunch of stuff on how you report on new development in your reports. I want to understand why. Why did you do these changes? What was the reason for it? And why is it good for the industry? Let's start there.
Okay. And you'll see me glancing behind me here. I've got my notes, and I did that not
Of
because I
course.
didn't prepare. I did that so I would not take 6 hours because I know this is a 1 hour segment. So everyone will thank me at the end for that. So first of all, the changes we've made, when we look at the industry standard reports, there's a focus on period over period price reporting. And usually that's in terms of average or median price per square foot, right? So we have pivoted away from that and intensified our focus into supply and demand economics. Now, I guess to answer that, the why did we do that, right? Why did we pivot away from period over period price per square foot comparisons as the majority of our reports? Now, I'm going to read verbatim. The answer to that is the new disclaimer on page 1 of all our market reports. And I'm going to read that, and I quote, since the group of units sold or under contract is entirely unique each reporting period, we cannot rule out that observed differences are simply a result of differing data sets rather than actual market shifts. Now, it's so fundamental. I'm going to read it again. I know it's annoying, but I'm an annoying
Go
person.
ahead. Go ahead.
So I'm going to read it one more time. I really want this to sink in. So again, quote, since the group of units sold or under contract is entirely unique each reporting period, we cannot rule out that observed differences are simply a result of differing data sets rather than actual market shifts. Okay, now, that's for the new dev, because when something, we talked about this, Noah, the first podcast or webinar you had me on, right? We talked about new development being like an IPO in the stock market. It's released one time and then it goes into the resale, right? Okay, into the resale atmosphere. Same with new development. So these units, when they're released, they're sold by the sponsor. They only appear one time, one data point, even if we go out 100 years, right? Once they retrade, they fall into the resale or the secondary market category, right? Okay, so when I say each data period, the basket of apartments that comprise or compose each reporting period are unique entirely, that is a factual statement. They are entirely unique. They're never the same. Not one apartment is ever the same. Now, if I were to rewrite that disclaimer for the resale market, I would just change it to say they're almost entirely unique every data period, right? Because Q3 2025 that just happened, how many of those same 1,000 apartments, I'm just throwing out a number, will also appear in Q4 2025? Maybe one, maybe two, maybe none, right? So they're almost unique every time. Okay. So to say this a different way, the price per square foot charts are just simply inconclusive. Okay. And
they're all over the place based on what types of buildings are trading in what specific period. And those buildings are completely apples and oranges, different products, different price points, etc.
That's well said. Okay. That's exactly right. And so the thing is, there may be market shifts in there, right? They could be what we could say, oh, there's definitely a trend up or a trend down. That could be true. The problem is, Noah, that we can't disprove that it's just a function of entirely different baskets of goods every single time.
Right.
Okay. So some reports do a good job of pointing this out, right? Like you just did. They say, well, that quarter, 220 Central Park South had a large number of closings or contracts signed, right? And then, in that year, there was a lot of really ultra luxury or several, new releases of buildings, ultra luxury. But the thing is, when you have to footnote that, every chart has 1, 2, or 3 footnotes, not only is it inconclusive, it just starts to be distracting. Okay. And then what's interesting, though, is that we just mentioned, a quarter with 220 Central Park South or a quarter a year with several ultra luxury building launches. What are we talking about here? Price per square foot or supply?
Right.
We're really talking about supply, right? So the point is that these price per square foot charts tell us a lot more about supply than they do anything else.
Okay. So one quick question. So
yes.
if I'm an agent and I'm trying to understand, I know we're going to go into the state of the market, actual state of the market, we'll see it in a second, but if I'm trying to understand this philosophically, what the market is doing in new development, I got to stop looking at a price per square foot level because of what you just spent 5 minutes discussing and why, how important it is, and look at it from a supply and economic standpoint, correct? So from a supply and economic standpoint, what are you looking at there?
Okay. So, and we'll go into that. When you talk about state of the market, we can actually go more into the specifics, right? The key stats, and that'll help explain it. But here's the thing. Supply and demand is a very well researched and studied field, right? And it gives us theoretically guideposts in different directions about when supply moves up, this happens. When demand moves up, this happens, right? And so at least we can use that to guide agents, clients, whoever's the recipient of our market report. And so we'll go into that a little bit more. But you know what it is too, Noah, that when we're advising or an agent is advising their clients, okay, whatever, we're developer facing, right? Agents are more, a lot of times consumer facing, right? The thing is, is it these price per square foot charts, historical, that are actually going to predict the future, or is it really the supply demand economics? So we need to be, as an industry, we need to be less rear view looking and more forward looking. And you don't do that with historical price per square foot charts, right? You do that with predictive analytics using supply and demand interplay in economics.
Okay, and we'll get into that. All right, thank you for that precursor. I know you thought it was important that we discuss that first before we go into everything else. Stephen,
Yes,
you're on the
sir.
horn. I want to know what the heck is going on with this market. Now that we know we can't track it on a price per square foot basis, what is going on in this market?
You know, this is a very interesting market, because if you look at all the different reports, irregardless of the way that others may report on the marketplace, there's a big divergence in the marketplace between dollar volume in sales and the number of sales transactions that have closed in this quarter and in general in 2025. So the high end of the market is roaring. Everyone talks about, well, the mayoral race, everyone's concerned. The mayoral race may be a concern for some because everyone has their own political views. But from a market standpoint, we saw 3 of the biggest transactions ever done in Manhattan on new development this summer, right? At 140 Jane. We've seen tremendous deals at the Henry. We've seen tremendous deals throughout the city. So the high end of the market, I would say certainly the $10 million plus market is, I think, better than it's ever been. More wealthy people are buying back into Manhattan than I've ever seen. And most of the developments that are out there right now that are in the pipeline are really building towards that high end of the market. And you pointed out to me an article that just came out in Bloomberg that actually talked much about that, specifically about the Upper West Side, which is a very inventory restrained marketplace. So you look at Mickey Naftali's 211 West 84th Street, the Henry, 70% sold. The building isn't complete yet, averaging over $3,000 a square foot. It's doing tremendous. Boutique buildings like 140 Jane Street, with an $85 million sale this summer, are doing terrific. So that end of the marketplace is doing very well. Developments that are in prime neighborhoods are doing very well. So, something like Maison Colette on Broadway and 12th Street, very inventory restrained market, absorbing like crazy. 80 Clarkson, as we know, has not reported sales, but we have our ear to the ground. It sounds like they're somewhere around 40% sold. Sales are occurring at over $7,000 a square foot. The first sale that they did there was a $7,200 per square foot, $35 million apartment, and it wasn't a penthouse. So the market is doing great on the high end. The middle market, depending on where the properties are located, I would say is sluggish.
Could you just define? So
middle market, I would say middle market is anything between, in Manhattan, $1 million and $3 million, right? Which isn't really the middle market. It's really the average market, right? It's where the average buyer can afford to purchase. There is really no middle market. There's really a lower market and an upper market. The $4 to $7 or $8 million market in non-prime neighborhoods is definitely suffering because those apartments were never really worth those numbers. But because of the cost of construction and because of the cost of acquisition, developers need to ask these numbers to try to justify making a profit. But a good product is going to sell. It just needs to find its watermark. But we definitely see a divergence between the upper end of the market and the lower end of the market. And then Brooklyn has almost no inventory. So anything decent in Brooklyn is moving very quickly. As a matter of fact, we just opened up a project in Hoboken at an average asking price per square foot of around $1,300 that we believe is going to attract buyers from Brooklyn because there's nothing to buy in Brooklyn for $1,300 a foot that anyone wants to live in, right? It's not in a neighborhood that most people think is a good investment. So, looking forward, what we're seeing is that once a project, let's say in the $1 to $3 million range, once a project finds its pricing, they move relatively quickly. But, you know, until you know what that pricing is going to be, because the market needs to speak to you, some of these projects have a little bit slower absorption in the beginning. The other thing is, you know, the third quarter is typically, you know, or the beginning, the end of the third, beginning of the fourth quarter is a very short market. So projects that launch, and we just launched 2 projects in October, really have 30 to 45 days to get some sales done, and then you have to wait until the middle of January. So for those projects in the $1 to $3 or $4 million range that launch this fall, I'd say we'll know in January, February, actually, how successful those projects will be or are.
Gotcha. It's a little too early to measure the success.
It is, you know, and right now, listen, there's a lot going on in the political environment. There's a lot going on in the international environment.
Right.
You know, the stock market is roaring, so people may not want to take their money out of it yet. But, you know, as I was watching on CNBC this morning, it sounds like that may start to turn, and I would not be surprised if we see a lot of money come off the table and go into hard assets like real estate.
Interesting. Fantastic update. Thank you very much. Thank you for doing the different price tiers. Jason, I want to give you a chance to chime in on state of the market. Any key analytics that we should know about?
Yes. So we're going to talk demand, supply, and guess what? Price per square foot.
All
Now,
right.
I just went on a rant about how we should step away from that, right? And I'm going to actually tell agents, though, it's still in our report, but at a decade level. And I'll tell you why we use that and how I think it can help explain the past, the present, and the future. Okay, so a few more minutes, if you'll give me, I'll go through.
Go ahead.
Okay, so price per square foot, and we even talked about, Steve mentioned Manhattan and Brooklyn. So let's do a little comparison, right? Start with price per square foot at a decade level. If you look at Manhattan, it's Noah, you'll know this term as a finance pro yourself. Chronic x-axis, right? Manhattan over the last 10 years is chronic x-axis or century flat, right? Now, Brooklyn shows a decisively upward trend. Okay, so let's talk about that. And the best way to understand that is not to look at Manhattan this decade, but to go back to the prior decade, so 2005 to 2015. Now, no one can argue there was a tremendous difference at the start of that decade and at the end of the decade in terms of average price per square foot, almost 100% different. Now, why can't we say that there was 100% or so appreciation? Well, to do that, the same, let's say 500 apartments that traded at the beginning would have to be the exact same 500 apartments that trade at the end. And we could track the year over year. But the chance of that happening is the mathematical definition of absolute zero, right? That is never going to happen. So then how do we explain that? Well, what can happen is that the composition of the product changes. Okay, so there can be trends in the composition of the product within that basket of apples or oranges, right? The trends in the composition, and that doesn't disobey the irrefutable mathematical fact that every single reporting period is absolutely different. Okay, so what I suggest is, if you look at 2005, there was no large-scale ultra-luxury offerings. Okay, Billionaires Row, that's all we hear every day now, was not even a term. Okay, around that time you had 15 Central Park West and even the Plaza renovation on Central Park South, of course, start to trade. And then it closed in 2007, 2008. You see the first blip. Okay, and then years later in 2010, 11, 12, 13, 14, 15, all of a sudden you have 220 Central Park South. I'm just going to make sure I hit all these. I'm looking at my notes. 432 Park, 157, 520 Park Avenue, 150 Charles Street, Walker Tower. The list can go on and on and on and on, okay? So what I suggest is that 15 Central Park West and the Plaza conversion were the tip of the iceberg. All these other buildings I just mentioned and handfuls more were the iceberg, okay? So what I look at is that, so the emergence of large-scale ultra-luxury product is a major factor in why we had such an increase in price per square foot average in Manhattan. Okay, so why has it been flat over the last decade? Well, I would suggest there's been a steady stream, a continuous stream of other luxury properties, ultra-luxury properties. Okay, so in other words, if we're going to use that iceberg analogy or metaphor, I'll say that the iceberg hasn't melted. It started in 05, 06. That was the tip. We saw the iceberg form in 2010 to 15, and now it hasn't melted, meaning that the composition has been relatively stable over the last 10 years of ultra luxury, luxury, affordable luxury, and economy. Yes, every single reported period has been a different basket, but the composition and the allocation of those have been relatively similar, and that's why we're flat.
It's almost like it topped out a little bit. It's like
Sure.
it topped out on kind of like where it could go, and it just kind of,
Yeah,
you know,
in the sense that, right, like the number of maybe ultra luxury that really pulls that number, right, at a certain time, you know, only there could be maybe so much release, because then we could look to demand. Or maybe there's only, I mean, how many, you know, $7,000 a square foot apartments can you, or 8 or 9, 10, right? So now, does that help to explain Brooklyn? Can we not use the same idea? If 2005 to 15 was the emergence of the age of ultra luxury in Manhattan, maybe Brooklyn, with that trend of the upward trend of the last 10 years, maybe it's been their age of luxury, right? The emergence of luxury. And you think about buildings, I don't want to miss any, but you know, you've had these Manhattan level finishes, Manhattan level amenities, large scale, and waterfront to boot. So we talk about, think Quay Tower, Front and York, the Huron, Olympia Dumbo, One Domino Square, Williamsburg Wharf. You know, these are very, very luxurious, large scale, high amenity, high product buildings, right? Like very luxurious product buildings. So I really think what happens in the future is so much more about the product rather than actually what the public's perception is, right? It's really, if you build it, they will come. I mean, I think if anything shows that, the city does that. And so, again, that long price per square foot monologue, what have we really been talking about? I mentioned building after building after building after building after building. We're talking about supply. It all comes full circle back to supply, right? So let's do supply and demand very quickly, because you asked about key stats. So again, price per square foot, average 10 years, Manhattan flat, Brooklyn trending up. Demand. Now, a quick thing on demand. Steve was really a proponent in bringing this to my attention, but we have to measure demand, unfortunately, by absorption, right? How many contracts were signed?
all right, so absorption is the pace, right? It's the
Right.
pace of, okay.
Exactly.
Yeah, exactly.
And wait, Jay, just hold your
Sure,
thought for a second. The
please.
reason I challenged Jason and my team on this is because, unlike other products, right, no one knows what the true demand is, because no one's out there with a clicker counting how many buyers are coming into every property every day, right? So, and no one knows how many buyers are prepared to purchase today. Different than walking into a store and saying, I have 100 widgets, and if I sold 100 widgets, you know, then that was the demand for the 100 widgets. But so when I'm looking at absorption, I want to look at how many units sold, but I don't know if I had 100 more of those units, if they would absorb, because I don't know how many other buyers are out there. So we're shifting the mindset from demand to absorption, because all you can count is the product that's there, because there's no factory pumping out more product behind it.
Interesting.
Yeah.
Okay.
So,
Yeah.
you know, I'm supposed to be the data scientist, and Steve literally educated me on this.
I'm just I'm just the idiot that looks at things sideways.
No. But it's really important. So let's to use another example. No, you probably heard about some of these Connecticut suburbs. Maybe 10 contracts are signed in a quarter. Okay, so you say, okay, 10 contracts, that means the absorption was 10. But what that doesn't show you was, to Steve's point, the 100 buyers that showed up to each open house on those 10 units. Okay. And the other 100 buyers that said, you know what, they called the broker and said, I don't want to be involved in a bidding war. I'm not even going to show up. I'll wait to a different market. Right. So the absorption of the contract signed, which is reported in this Connecticut example, was 10. The real demand could have been hundreds. Okay. So the point is, demand is almost always less than absorption, because absorption is really just the demand that the market dynamics allow to manifest as contracts signed.
Okay. So where are we on absorption? Are
Okay.
we low? Are we high?
Okay.
Are we
So here's the thing. On absorption. So what we're going to do is we're going to tell you the absorption numbers. But we have to keep in mind, we take this with a grain of salt, because like Steve said, to really get the demand, we'd have to call every single broker, How many people came to your open house? How many people inquired? How many people were involved in a bidding war? It's impossible. Manhattan was down about 15% over the historical 10-year. And Noah, what we do is when we say 10-year, I'm looking at third quarter because I want to take out or adjust for that, account for that seasonality. Okay. So on a third quarter basis for 10 years, Manhattan's down 15%. Brooklyn was down about 3%.
Right. And that's over the 10-year average of absorption of units, but that doesn't look at how many units are available on the market to be sold, which is why it's nearly impossible to say the market is up or down absorption wise, because you then have to layer in inventory numbers.
Supply, right?
Supply.
So, all right, I understand. It's like just the analogy I'm going to say is me trying to figure out market pulse without having supply and demand, because those are the components of the market pulse. It's just it's a derivative of those two factors.
Yeah, it's not like a bond or a stock where there's a bid and an ask, and you're working into the middle. So that's something. And it's interesting because I saw one of the questions that came up in the chat. Rudy Hanya had asked, are these uber expensive apartments that are absorbing, are they selling at asking price? A lot of them are. There are some, and they've been reported, penthouses that were cut by 50%. But for the majority, Rudy, I would say right now, on the high end of the market, things are selling for a very near asking price, unless it's grossly overpriced at a penthouse. Literally, that's where we see the biggest discounts in ask versus bid is in these penthouses that are typically, in a lot of these projects, grossly overpriced.
Right. Quickly on supply, are we just give me a short low, mid, high, or basically low? It sounds like Brooklyn's a lot lower than where we are in Manhattan, I would assume.
Yeah. So it's funny, right? No, I've said you can't pay attention to price per square foot. You have to take demand with a grain of salt, or absorption, right? So what am I going to say about supply? Well, supply is one of those things. Thanks to the mandate of having to submit offering plans, supply is actually that one metric where we can really kind of put our finger on it, right? And we'll talk about probably pipeline in a second, I assume.
Yeah,
and that's another thing, because of permits, the mandate of having to file permits, we can also start to have an idea about pipeline. But where are we? So Manhattan was at about 31 months. We like to talk about numbers don't help as much. Months of supply is a better
months of inventory. Is that kind of like what? Okay.
Yeah. Now inventory it's a little different in resale, right? In the new dev market, we call it real supply because we're talking about active and shadow. Okay, so active.
And what percentage is active versus shadow? Like what do we see versus what we don't see, kind of thing?
Good question. Steve, chime in, please. But I would say about 1/3 and 2/3.
Yeah, sounds about right.
Yeah,
one third we see, 2/3 we don't see.
Yeah, that's right. I mean, right, the public doesn't see. We see it because we collect Schedule A's and we take a look at total inventory, but the public doesn't see what's in the shadow.
Okay.
Yeah.
Okay. Go ahead, Jason.
No problem. That's a great question. So that number, that real supply, the aggregate of both active and shadow, right, is about 31 months. And in Brooklyn, Steve said Brooklyn has a lot less inventory. They have about 17 months. So almost half of Manhattan. Okay.
Interesting. Yeah, that's very good. I want to go to pipeline. Yeah, go ahead.
And just one quick thing on that, Noah. It's really interesting to note. I'm not going to talk. Is this called Talking Manhattan still?
No.
Is this
I mean, we could do a live webinar.
But you have a Talking Manhattan, right?
Yes.
So let's talk Manhattan for a second.
We're very chaotic over here.
No,
we're still trying to get our shit together.
Let's talk Manhattan. So what's interesting is that over the last, absorption, again, lower than real demand, right? Over the last 10 years, averages about 1,500 contracts in Manhattan a year. Okay, in the first part of the decade, 16, 17, 18, 19, 20, 21, 22, the first 7 years, we were taking out 1,500 contracts, means we were removing 1,500 units from that real supply number. But new supply coming on, whether active or shadow, the both, was about 1,900 units. So we were building a surplus in the first.
A net gain, yeah.
A net gain. Since then, 23, 24, 25, the net has been negative about 600. So it's very, as we lead into pipeline, because we see, I'll just kind of sorry to take away from anyone's like the steam we're building, but we see that same, almost that exact same number going forward. Is that it's about
the net negative trend.
Yeah. So right now, again, 1,500 contracts being pulled out as contracts, right? Or units being pulled out as contracts. Instead of 1,900 being placed in every year for a net gain of 600, the number's about 900. So it's a net loss of about 600 every year. So we have this pile that we're just depleting and depleting and depleting, and we don't see that changing a lot.
Well, yeah, because we're not
Wow.
adding supply as quickly as with depleting supply, right? So, you know, in our report that Jason masterfully put together, you know, the average number of new units coming to Manhattan is about 1,500 units, 1,496 units a year. Right now, we're from 23 to 28, we're only seeing an average of 883 units coming, right? Right, Jay?
Well, so Steve, the 1,496, that's the demand.
I'm sorry, that's a demand.
Yeah.
Right.
So right. So we're only seeing about 900 hitting the market. And so
Right.
what Steve is referring to, that was the last 3 years. But when we did our pipeline, which we are, the analysts that work with us, Thomas Abreu, he's put and Robin Schneiderman have both put a huge amount of time into studying the pipeline because it's very important. And that 900 a year, if we space it out, 26, 27, 28, which we like to take about 3 years, that's about as accurate as we can be. It continues to be about 900 a year.
Yeah.
So for 6 years, the past 3, the future 3, we're talking 1,500 contracts, assuming it stays, only 900 new units replacing that. We're just depleting.
Yeah,
Now,
and we're going to be eating each
if-
other's scraps at some point.
well, and see, Noah, that's the whole thing, is that when you say price per square foot can be largely a distraction, demand we can't really pinpoint. Let's really focus on what we can focus on, or we really have some idea of is supply. There's the real story, that we're depleting it. And Noah, you're a much better financial professional than I am. You know, supply demand economics. When supply tightens, things have to happen. Either the public says, "Oh, I love that inventory, we all want it," the price goes up. Or they say, "You know what, I'll stay on the sidelines." Or they say, "You know what, I'm done with new development for right now, I'm moving to resale," and that helps the resale market. Or they say, "The city, I can't do it right now, I'm moving to the suburbs." We don't know, but we know herein lies the story. It's not about past price per square foot. You know, it's not about absorption that really can't tell us demand. It's about the supply story. That's
Right.
what it's about.
Right. And if you look at the supply, about a quarter of the total supply that's either active or in shadow right now is in 4 buildings or 5 buildings.
That's
right. So, you know, and this isn't an opinion on those buildings. It's just a fact. 1 Wall Street, the Waldorf Astoria, 1 Manhattan Square, 125 Greenwich, and the Malabar, which just launched. So we take that one with a little grain of salt. They make up about a quarter of all the supply that's out there right now. So the supply is really very limited when you take those 4 or 5 buildings out of the equation. And again, not that they're not going to sell, and not that they, you know, they're bad buildings. They're huge buildings with a huge amount of supply that are absorbing at a less than average absorption rate.
Interesting.
Well said.
Stephen, I want to pivot to pipeline. We talked about pipeline. Tell me if any specifics, if you know, about what we need to know about pipeline, future pipeline.
Well,
Anyway.
I think part of the pipeline is that, you know, the pipeline is very, very thin, right? So, you know, the Upper West Side, you know, they just announced Extel's ABC Disney site is going to be, you know, well, we've all know where it's going to be developed, but basically what's going to go there. But that's years and years away. You know, we have a project coming on the Upper West Side. It's going to be only 36 boutique units, so it's not going to add much supply to the Upper West Side. The Henry's almost sold out. You know, Lower Manhattan actually is starting to see a little bit more supply. So right now, pipeline-wise, in the fourth quarter, you've got 5 basically buildings that are expected to launch. You've got, you know, 26 West 9th Street, which is the conversion. The Flatiron building, which has kind of seemingly soft launched with 1 sale, and I'm sure much more coming. You know, you've got Linden Lane, which we just launched over on 51st Street in Hell's Kitchen. 1122 Madison is supposed to come. If I look at all this together, you're talking about less than 40, 70, 130 apartments. right?
Wow. And what about
Launching.
permits? Like, is there any early indication that the early stages for future years is rising, or is permits still down?
No, permits are, so Jay, you can jump in, but permits are down. I mean, the over the next 4 years, we have a dwindling supply, and if demand remains where at a constant of a 10-year average, we're going to be at like a 0.7 to 1 ratio or so of units coming to market versus supply,
If
which
if
indicates to me that prices are going to go up.
if the rental market keeps doing what it's doing,
Yeah.
let's do a little situational awareness thought experiment. We're in 2025 right now. Let's transport to 2027. Let's just do that for a moment. Thought experiment. If the rental market keeps going up like it's doing, right, for the next 2 years, 3 years, and the sales supply new dev continues doing what it's doing for the next 2 or 3 years,
Yeah.
I could see a fundamental shift in the sales market at that point in time
Well, yeah,
down the
I
road.
think we're already seeing it, and that's why we see, someone in the chat mentioned, boomers are feeding the market. They are. Boomers are feeding the high end of the market with Uber purchases, and they're also feeding the average market with helping their adult age children purchase apartments from 1 to 3 million or so. So, why are they doing that? Because rents are so high, and even with a couple of Uber rental buildings, coming up like Water Street and Pfizer conversion, those are still only a few thousand units. It's not that much. Back in the 50s, we were adding 20, 30, 40,000 apartment units a year. We're adding like a couple of thousand a year now. So
Wow.
the rental market does not have an end in sight right now. And again, I don't want to get political, but if the purported winner of the election occurs and tries to freeze rents on rent regulated apartments, that's only going to create a lower supply and raise rents for everybody else. Okay. So, and there's thousands of units right now that are just not on the market because it doesn't
Warehouse.
economically make
Yeah.
sense to rent them, right?
Which was also policy driven from
Which
2019.
was a policy driven from 2019, which has seen rents go up 30% minimum. We just worked on with Gotham on the Mayberry at 41st and 10th Avenue, an amazing project that Josh Young led, a great team. And we rented that building out, 306 or so market rate units in 1 year at well in excess of $100 a square foot. I won't get to the exact number because that wouldn't be right, but well in excess of 100 a foot. I know that Taconic's project on 43rd Street is purported to have averaged $109 a square foot. The anagram is supposedly like 130, right? I mean, we have developers coming out right now for high-end rental buildings projecting $150 a foot and up. We have developers coming out for your average rental building at $115 and up.
Wow.
So when numbers get that high and interest rates are easing a little bit,
Yeah.
it's going to push more people to the purchase market with such little demand, such little supply and high demand, prices are going to go up. I think anyone who buys right now is making a really smart decision because we are just not going to have enough inventory. And with return to work, I mean, look at the office market. Office market is flying. Why? Because people are actually coming back to work.
And that's another backbone of our market, right? That's another tentacle of the beast, of the machine that kind of works.
100%.
It's interesting. Jason mentioned the decades theory, from 2005 to 2015, that was a hell of a period. From 2015 to 2025, we ain't done nothing.
No. And remember, from 05 to 15, we had a recession in the middle of that.
And in 15 to 25, we had 0% rates for 3 years.
That's right. But we when coming out of the 08-09 recession, some very astute developers really thought that the development market wouldn't turn around until 15-16. It turned around in 11-12. And and there was a lot of construction going on because rates were coming down and there were some good deals on land. And so supply was added. We're not adding close to that supply now. and our city
Wow.
continues to grow.
All right. I'm
So
going to move on.
just
yeah.
really quickly,
Jason, go ahead.
so fast. Noah, the scenario you proposed and the discussion you and Steve just had, you two answered better than I ever could in 30 minutes about why we transition away from period over period price. Third quarter did this and fourth quarter was at this 2,000 square foot, into a focus on supply and demand. That conversation you two just had answers it better than anyone possibly could.
It's a different, I feel like we're about to re-enter the 5 to 15 period, but we're still a couple of years away from it. I feel like we're at 2003 right now,
and see,
you know?
but this is where the story is, right? I mean, this is how you add value as an agent to your buyers, and this is how, as new development, how we add value to clients who are developers.
Yeah.
Predictive analytics.
All right. Stephen.
Yes, sir.
Could you talk about the current state of the lending environment for developers right now? What financing a project, stuff like that?
It's not easy. It's not easy. More equity is being brought to the table on almost all these projects. It's funny, you talked about like 2005 to 15, and I remember a colleague making a comment back in the early 2000s about, developers who are developing, but they really weren't developers. And he phrased them dentists from Long Island, right? So we had a lot of development going on by less experienced developers because money was flowing. It was easy to get money. Anyone, literally, my dog could get a mortgage, right? So forward now, it's really hard to put together a deal. You're looking at 30 to 40% equity, and then that gets syndicated out. The players in the equity and debt markets have changed as well, from kind of less traditional lenders to more national lenders who are either fund-based or groups of investors. So, building is much more difficult, which is why you see the Legions and the Naftalis and the Extels and the Relateds of the world and the Jeff Levines of the world able to develop, because they have such a track record that they can still find money and they can get money at reasonable rates. Gotham, the same thing. It's much more difficult today for a no-name developer to borrow. So that's also what has created this slowdown in inventory coming to market. Is it's just less qualified developers. So there's new developers coming in, like national developers that never developed in New York City before, actually coming to the market now for the first time because they see an opportunity to jump into a little bit of the role that the no-name developer was filling before. We also see a lot of contractors, a lot of construction companies coming into the marketplace because obviously they can slightly cut their margins on their construction to make the deal more attractive to a lender to borrow. So there's been a definite shift in the marketplace in general. I don't see that changing anytime soon. Particularly, with again, global environment and, also a lot of these investors that used to invest or lenders that used to lend in real estate, they've now also shifted to other areas, to tech, to transportation. Fortress is literally funding, and building the rail from LA to Vegas. So they've made a massive investment in that, right? A Brightline type of thing. So these lenders have diversified what products they now focus on. So there's less opportunity. So there's less pool, which means you got to be a bigger, stronger developer in order to borrow money.
And there's only a finite number of those guys. So you got a tougher financing situation. More newer, less mature class of developers in a higher inflationary or perceived inflationary environment where the sales market has been stagnant for 10 years. I'm starting to see how the math ain't mathing.
Yeah.
And I'm not a developer.
Yeah. And we have clients now, their equity partners are from all over the world. Most of these deals used to be very local deals. Now we've got partners from all different corners of the world, from India, from Japan, from the Middle East to Europe. So, it's really quite fascinating, actually. And then there are some new funds that have come in to fill some of the roles, like, Madison Equity, they've been around for a long time. They lend a lot. There are some new competitors to them that are coming into the equity side of the equation to provide, more cash down for a project, but still going out for financing is still very, very difficult. And the 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 political environment doesn't help that.
Yeah. All right, really interesting. All right, I got one more question. Jason, this is going to be for Steven also, this last one over here, but hang tight. I'm sure we're going to get to you soon.
I spoke plenty, that's for sure.
Well, we want to hear from you more. This is my opportunity to talk to the audience right here. Last chance to send in your questions, guys. Please send in questions right now. We got about 5 minutes plus left. I see that Steven answered a couple questions here. I got one question I'm keeping on the side. Steven, don't answer those other questions here. I'm going to keep that on the side for later. But I do have a key question for you. I just hope the audience will send in more. Steven, last question. Okay. What key amenities and features are going to define the next wave of development? What are buyers asking for?
Yeah. And by the way, I see a tremendous number of attendees that I've known for the better part of 30 or more years. So,
Awesome.
lay those questions on us, folks. So amenities. Amenities, it's funny. Amenities got very, very conservative back in like the 2015 to 2017, 18 development world. Amenities are driving projects again. So we're starting to see pools again, which we didn't see for years because they are quite costly to maintain. Pools are very in, but what's really in is wellness, and pools goes along with that. So things like infrared saunas, steam rooms, meditation rooms, salt rooms, hammams are all very, very in. Training rooms, Pilates. Oh my God. I mean, if I don't have a Pilates studio in a building right now, I may as well not have a fitness center at all. Everyone does Pilates now. So, that's become very, very in. Real concierge services, something like, what Abby delivers at Live Unlimited, where it's not about getting you a reservation at a restaurant. It's about helping you organize your life. It's about, the owner that lives part-time in New York and part-time elsewhere, wanting to come home to a full refrigerator, wanting to come home to, their apartment being clean before they get in, wanting to come home to, maybe their pet is being delivered back, from a friend, finding dog walkers, things like that. Are very, very important. People can get their own reservations. They need people to help manage their lifestyle. So that's become very, very in. Putting amenities not in the basement, putting amenities at an upper floor, a mid floor, a top floor, in order to avail everyone in the building to those views and to that lifestyle that not everyone can afford to live at the top of the building has become very, very important. Where you can find it, parking, right? So, it's funny. In Brooklyn, all the developers want to get rid of the parking requirement because it's onerous. In Manhattan, the parking becomes a major amenity because it's a very limited opportunity. So we're developing a building on the Upper West Side. If we could have one-to-one parking, we would. We can only have a parking for a third of the units in the building because that's all the city will allow us. So, and particularly with more bike lanes and street side dining, parking in the city has become very, very difficult. So parking is a major, major amenity that has become very, very important, particularly in buildings that are, in the $3,000 and up a square foot range. So, I'd say those are really important. Cold plunges, everyone wants a cold plunge now. That's another one that has become really popular in the last couple of years. And anyone who's done a cold plunge knows once you're hooked, you're completely hooked. As soon as you take that plunge and hold your breath as you gasp, after that, you'll do it every day because it's super good for your muscles. It's great for recovery. So these are all amenities that are very, very highly sought after. The other part, I'll leave you with this one too, particularly for buildings that are built more for the boomers, card rooms. Whether it's
a golf simulator,
Well, I was going to say in golf simulators, sports simulators and card rooms. So whether it's
Poker room
playing
and golf
cards
simulator.
or
That's all I need. And a
mahjong,
bar. And a
right?
bar.
You know, or multi-sport simulators that can do golf and all other kinds of things. These are
Awesome.
super in vogue. They're not expensive really to install, and they're low cost to operate, which is really great because you know, someone's mentioning, you know, how taxes keep on going up and condo fees keep on going up. A lot of these amenities are not expensive to operate. The pool's expensive to operate. The cold plunge is expensive to operate because you have to have people maintaining them all the time. But most of these others, once they're purchased by the developer, they're really low cost.
I love it. I love it. Dude, the game room is just, I mean, you put a game room in there, you'll be all right. Pool
Yeah.
table, dart room. Yeah, absolutely. Poker and golf.
Yeah.
And invite me over.
Definitely.
All right, guys. We're done here. We're supposed to ask questions. I was supposed to have a list of 140 questions. I was going to make you guys give me a question when you registered because I knew that not everyone would send a question.
Yeah.
We have a couple of questions. I got 2 questions. Could you guys send more questions for the next couple of seconds? But I got 2 questions. Jacob Wood, we just interviewed him. He was great, by the way, talking Manhattan. I get that lenders have diversified their investments, so there's less money to lend to New York City developers. What spurred that change in lender behavior?
A couple of bad investments.
Probably.
You know, literally, you know, there were some projects out there. Listen, I think COVID opened the eyes of a lot of people that you need to diversify, right? Because an event can be devastating, particularly in real estate, where the carrying charges, the real estate taxes, the maintenance, the security of a site. So if you built a site, right? Like let's just take 200 Amsterdam, for instance, right? So we were working on 200 Amsterdam all through COVID. The issues with the neighborhood aside, okay, we built, or our client, SJP, built through the entire process of COVID, they built every day, but it cost them a fortune to continue to build. So you know, they and their lenders and their partners said, hey, look, you know, these kind of things can happen. We need to diversify a little bit more, right? You know, also there's new opportunities with technology and with the growth in the nation. There's other opportunities to invest elsewhere. And I think a lot of these funds, as they got larger, realized that putting all of their investments in one single marketplace, just like any other normal investor, it's not a good idea, right? You know, listen, I'm involved in real estate, so I try to diversify my financial portfolio with real estate and non-real estate assets because, you know, if my income were to suffer because the market suffers for a few years, hopefully my other assets, are producing for me. The funds are looking at it the same way.
Really interesting. Do we still see international buyers?
We did. It's slowed in the last couple of months. Again, you know.
Oh, we did this year. Okay,
We
so
did
it was
this year, yeah. The beginning of the year, we saw a lot of international buyers. The Asian buyer has been the predominant international buyer for the last decade plus. We continued to see that buyer. We're not seeing as much of it right now. I think it's because of the political atmosphere right now. So we're not seeing as many foreign buyers as we did. And we're also not seeing as many foreign students coming into the rental market as we did, which is something that I think we're going to have to take into consideration in the future if this continues.
okay. What neighborhoods have the most and least new development coming into the pipeline over the next 1 or 2 years?
So,
Go ahead,
good,
Jason.
good questions all to everyone. And I pulled that up when I was quiet for a few moments there.
Yes,
Let
thank
me
you.
so to whoever asked that question, it's a good one. And I wanted to tell you too, I mentioned this to Noah. A lot of times with supply, we speak in terms of not just raw units, but in months of supply. So I'm going to give you some of both. Okay. So just follow along with me here. Let me switch over. Noah, you can still see me, right? I've
Yes,
lost.
I can. Yep.
Okay.
You're good.
So look at it this way. Hudson Yards, there hasn't been, you know, you had 15 Hudson Yards, you had 35 Hudson Yards. Those are nearing sellout. So there hasn't been a lot of contracts signed in Hudson Yards. So there are 167 pipeline units coming over the next 3 years. Now, again, these numbers can change. They can halt development. They can get delayed. Anything can happen. But right now, 167 units means 200 months of supply. Okay.
Wow.
Billionaires Row has 300 planned units. or so we believe at this time. That's 138 months of supply. Okay, now that's more in a months of supply level, right? What units, what neighborhoods have the most actual unit number? Midtown East has what we believe to be 507 units on the way, which is 29 months of supply. Now, why a big number for the units and a small number for months? Because there's just a lot of activity there, a lot of contracts being signed. And in second place from that category would be East 14th to East 34th Street with 420 planned units representing 33 months of supply.
Interesting.
And then least, I think it'll make sense to everybody. Lower Manhattan, especially not picking on the building, like Steve said, it's a very large building. One Wall Street is so big and is sucking so much air out of the room, so to speak. Lower Manhattan has a pipeline supply right now. We could find a single 9-unit building planned for Lower Manhattan. And I think because developers just see there's so much inventory there already, even just with one wall. You had 125 Greenwich Street, which was 271 units. There's some big buildings downtown. And so developers see that and are slow to want to jump on the bandwagon of adding more units. I hope that answers that. Okay.
Yeah, that's a great answer. Thank you so much. I got a couple more questions here. Let's rock and roll. Do you see more buyers purchase homes as primary residence or an investment? How do buyers see luxury condos as investments?
I mean, I'd still say the majority of buyers are primary residents, or co-primary is another term we like to use, because maybe they're living 3 days in the city and then 4 days out of the city, but it's not an investment per se. They're not renting it out. I think that the luxury market is a good opportunity for an investor in a condo, because there just aren't a lot of real luxury rental buildings. When I say luxury, like condo quality rental buildings in prime locations, right? The best buildings are on the fringes, right? Those are the ones with the most amenities and the best finishes. Not number one, because they need to do that to drive the tenant there, but number two, the cost of land's a little bit less expensive, so they can afford to do it. So I do think that, there's an opportunity in the luxury market for, 50, 60, 70, $80,000 a month rentals, because there just aren't that type of quality out there. Will wealth demand meet the huge pipeline? That's a really good question. I don't think equating our market to Miami is a reasonable analogy. The Miami market is a highly speculative market that is very dependent upon transient, right? It's very dependent upon the South American marketplace and equity flight and preservation, and it's very dependent upon kind of migration, right? So I think that the Manhattan, New York City marketplace has proven that there's enough demand to meet the supply for the majority of the product out there. But some of the product out there has been designed on development sites that are a little bit challenging, and thus the layouts don't meet the demand of that high net worth individual. So when you have a great building with great floor plans, they sell. But when your building starts to tier back to the penthouses, but those floors get very narrow, that's where you start seeing those units linger, because they just don't lay out well. And bottom line is, people buy location, amenities, and layout, and not necessarily in that order.
Awesome.
And
I
just wanted to
go ahead, Jason.
Just to add really quickly to that, I just wanted to say, almost as an asterisk, that everything I said today was at a borough level, right? I talked about Manhattan as a whole, and I talked about Brooklyn as a whole. And I think that question, what Steve the great answer was that it's very different on a neighborhood by neighborhood basis and on a building to building basis, right? I mean, talk about ultra high net worth demand. If you were to build, or someone was to build, another 220 Central Park South, right, with guaranteed eternal unobstructed views of Central Park on Central Park, that thing would be absorbed at a record pace, right? Another 150 Charles, massive outdoor spaces in West Village on the river, again, would be another scenario, right? So it really just matters project to project. So what I encourage people to do with the thought process we've given you with this philosophical look at things, right, is to take that same thought process down from the borough level to the neighborhood level to the street level like this. I think it's a great way to think about things and to advise your clientele.
Yeah, every building trades like its own market, and that's like especially true in new development.
That's right.
Bree Train, you had a research analyst at Corcoran Sunshine. Bree Train, are you seeing bigger discounts and negotiability in oversupplied markets, or are developers hoping and holding out for market improvement that may or may not come?
Yes.
Hmm.
No, Bree.
Okay.
It really depends, as you know well, and say hi to Jordan for me. As you know, it really depends on how long the project's been out there, what their capital stack looks like, what their loan looks like. Uh, I have clients that are holding out, waiting because they think that not they think we know we have a substantially, a great product. And we're just waiting for the market to wake up a little bit because this fall market's been a little sleepy. I have other clients who are saying, if I can get those numbers but get out in 9 months, instead of 18 months, sure, I'll take the deal. So it's really deal to deal. But in general, as we all know, developers like to try to hold on with their fingernails until the last minute. They don't always listen to us until sometimes it's too late. What I can tell you is that if we feel like a deal is a reasonable market rate deal to take, we're suggesting the developer to take it because you just don't know what tomorrow looks like. But if we feel like the offer is below what the product should be selling for, then we're going to suggest that they hold out.
What are concessions real quick? Are there no?
Closing costs, transfer tax, attorney fee, maybe
Okay.
6 or 12 months of common charges and taxes, are still kind of the norms. If you've
You're
got a
not going to
storage,
insult any developer by asking for that kind of stuff.
no, I mean, if you got a storage unit, that's something that could possibly be negotiable. I don't see a lot of developers throwing parking in unless they have an exorbitant amount of parking, because parking is a very valuable asset, and they can always turn it into a lot that they lease out to a third party, vendor as well. So, kind of still the same standard concessions, but I will tell you, obviously, I think everyone here knows that. Developers would much rather hold on price and give concessions because it's good for the project to show full price deals, and frankly, it's good for the owners in the building to show that things sold at a high value as well.
Yeah, a good little leverage point for negotiations. God, we are done. We are done. We went the full hour. I want to thank my panelists, Stephen Kliegerman and Jason Thomas. You guys were absolutely awesome today. I want to thank my viewers and the audience that came here today for asking the questions. Please, if you guys could reach out to these guys, say hi, say thank you, start a relationship. You never know when you might do a deal with them. This is a relationship business, and these guys rock. So with that said, thank you, Stephen Kliegerman. Thank you, Jason Thomas.
Thank
Brown
you,
Hammer
Noah.
Stevens,
Thank
Development
you.
Marketing. Till next time, this is Noah Rosenblatt with UrbanDigs, and I'll catch you next time.
Thanks,
Cheers,
guys.
everybody.